Here we have two A-rated soft drinks. One, I'm going to shake it up completely. The other one is cool and calm. If I open this, I know that nothing is going to happen. It's predictable. But how about this? It is full of pressure and shaken. And if I try opening it, it might just explode. That's exactly the difference between historical volatility and implied volatility. Let me explain. Hi, I am Pranav VK, your volatility guide here at Stockshaala by Kotak Securities. In this video, we are going to understand what is historical volatility and what is implied volatility, and finally, we are also going to learn how to use them in our trading journey. Volatility can tell us how wild the market could get, but not all volatility is the same. There are basically two types of volatility. One is historical volatility and the other one is implied volatility. Historical volatility is like your report card, whereas IV is like your expectations of your teacher. Historical volatility is what actually happened, whereas implied volatility is what the market thinks will happen. For ease of understanding, moving forward, I will refer to HV for historical volatility and IV for implied volatility. HV is calculated from past price fluctuations. It is measured as a standard deviation. In fact, it doesn't affect the premium prices directly, but rather it is used for backtesting and strategy building. Now that we have understood HV, let's head to IV. IV is the market's forecast of upcoming movement. Higher IV means higher uncertainty, which means higher premiums. Lower IV means lower uncertainty, which means lower premiums. IV is built into the options premium. So you pay higher if IV is high, whereas you pay lower if IV is lower. When IV is lower, it's also that the expectations are calmer and the uncertainty is very low. IV is somewhat like the ticket prices of a cricket match. If it's India-Pakistan, then the IV shoots up and the prices are sky high. Whereas if it's a different country, then probably the IV is lower and the ticket prices as well. Let's talk about a simple but an important topic called as IV crush. When there is earnings or major global events, the IV increases significantly, leading to higher premiums. But just exactly after the event, if there was no significant announcements, then the IV falls significantly, and that is called as IV crush. And that is why buying options just before an event when the IV is already high is very risky. Even if you had the correct direction, you will still make losses because the premiums will start falling because of the IV crush. Now let's discuss how IV impacts options pricing. Let's head to the whiteboard to understand this example. I'm going to take the same call strike of 19,500 and see how the premium varies across two different IVs. One IV where it is 15%, the premium is trading at 60 rupees, whereas the other one, IV is trading at 30% and the premium is trading at 90 rupees. This is because higher the IV, higher the fear, because of which the option seller will be pricing the premium a much higher rate. Whereas if IV is lower, then the risk associated with it or the uncertainty is also lower, because of which the premium is also lower. So here, nothing else changes. Just the fear of movement is going to increase the premium prices. Let me give you an analogy to help you understand this better. Think of it like health insurance. For a person who is aged 25 years, the health insurance premium is comparatively going to be lower compared to a 65-year-old gentleman, because the possibility of a 65-year-old gentleman hospitalizing is higher compared to a 25-year-old. Similarly, the same case in IV as well. Now let's discuss when to use IV in strategy selection. So let's head to the whiteboard. Here I have taken 4 different IV scenarios. One is low IV, one is high IV, third is rising IV, and fourth is falling IV. If the IV is low, then you can go for a debit spread or buying options. Whereas if the IV is high, then you can go for credit spreads or selling options. Whereas if the IV is rising continuously, then you can go for buying early even before the actual move. Whereas if the IV is falling, in this case, you have to avoid buying naked options. You can find IV data on option chain platforms. So let's summarize what we have learned so far. We know that HV is nothing but historical volatility, and it is dependent on past price fluctuations, and in fact measured as standard deviation. Implied volatility is about what the market thinks might happen in the future. While HV does not affect the premiums directly, it is used for strategy building as well as backtesting, whereas IV affects the premium directly. Higher the IV, higher the premiums. Lower the IV, lower the premiums. Because if IV is high, it means the uncertainty is also very high, and the vice versa. So always make sure to check your IV before you enter any trades. And finally, avoid buying in IV crush zones and prefer selling when the IV is high. In the upcoming videos, we're going to discuss about some real examples of IV crush during the earnings season. So stay tuned. I am Pranav VK and you're watching Stockshaala by Kotak Securities. If you got clear clarity on IVs, then share this with your friend. I'm signing off and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.